Today we're talking about investment options, particularly things you need to consider if you are going to be outside of the United States and trying to invest. But before we jump into that, if you're new here, hello, I'm Adelia Borchade. Most people know me as Picky Girl Travels the World. I help Black women master their money so that they can live life on their terms. I'm all about helping women navigate the intersection of finances and travel because let's be real, you can have dreams of traveling the world or moving abroad, but if you can't figure out your money, you're never going to be able to live those dreams. In an effort to specifically help you develop the confidence you need in your ability to master your money, next month I'm opening up my financial boot camp. It's called Financial Confidence Boot Camp. It's a 4-week program. I'm going to put a link up here and I'll put a link in the description if you would like something more personalized than a YouTube video to help you on your path to financial independence. Okay, first of all, before we jump into like 401ks and IRAs and all that, let's back up a little bit and let's talk about what is an investment. Now, if you are new here and you haven't had a chance to watch the video I did about why savings is a losing game and not where it's at, you'll definitely want to check that out. That video is linked in the description. I'll link it up here as well. But in that video, I talk about why you really have to invest if you're trying to do big things with your money. You got to put that money to work. And that's in essence what an investment is. You are using your money to make more money by buying something that you hope will go up in value. So that means anything, including real estate that you are buying with the hopes that you can either make money off of it every month, or in the future you sell that real estate for more than you bought it because you're using your money to make more money. Bitcoin is an investment. Y'all remember Beanie Babies? How some people thought Beanie Babies were gonna be their retirement fund? Because again, they bought those Beanie Babies hoping that they could sell them for more later. Investing in a new startup, because again, you're hoping that you put in some seed money and that investment will pay you more money in the future. And then of course, there are things like stocks and bonds. So one, I think we have to be cognizant that there are lots of different investments. They all have varying risk associated with them. Because if you're trying to keep your money safe, you're not going to make any money. So it's really about taking a calculated risk. Investing your entire retirement fund in Beanie Babies was very risky. And here we are 20 years later, and we know that that was not a smart investment. So that's the other thing we have to keep in mind, is that when we make an investment, there's risk associated with it. You have the risk that you could lose money, but hopefully you are you're making a calculated risk and you are choosing an investment where you've done your research and everything is pointing to the odds being very good that you can make more money. Now, that really is a perfect segue into how do you choose an investment? I've given you examples and that's like the tip of the iceberg. That is not an all-inclusive list. But how do you decide which investment is right for you? This is an area I don't think enough people pay enough attention to because they're like, well, such and such is buying Bitcoin. I'm going to buy Bitcoin. But maybe this other person can handle lots of incredible fluctuations that you really don't have the stomach for. So that would make Bitcoin a very bad investment for you. When you are deciding what to invest your money in, there are a couple of things you need to think about. One is, what's your time horizon? When will you want to pull this money out? When will you want to use this money? Because if you need this money in 6 months, investing is not the way to go. Okay, you need to put that in a high yield savings account or something like that, because investing is too risky when your time horizon is that short. But if you don't need this money for 20 years, then you can afford to take more of a risk because there is a loss in value, a decline in value. You've got more time to recoup that. So I think enough people don't pay attention to time horizon. They get so caught up in how can I make the most money from this investment, when yes, that's a concern, but you also want to balance that with, when do I need this? Does the amount of risk I'm taking make sense for what my time horizon is? The other thing you need to consider when you are making an investment is your risk tolerance and your risk capacity. Your risk tolerance is how much up and down can you personally tolerate. If you're somebody that freaks out because your investment lost 10% today, and you're like, oh my gosh, I need to sell everything, then you have a very low tolerance for risk. You want to be more conservative. If you can handle some ups and downs and some uncertainty because you're okay with the potential bigger payout, then you can be more aggressive. But I think in order to be a successful investor, you really have to be honest with, if you are deathly afraid of losing money, don't invest very aggressively. Now, I'll put in a chart here to show you kind of what that means if we're looking at stocks versus bonds, because stocks, things like Bitcoin, cryptocurrency, those are far more risky investments because they have more room for volatility, but the potential payoff is much bigger. Some people are okay. Like, what kind of gambler are you? That's really what risk tolerance is about. What kind of gambler are you? Do you want to take a big risk with your money? Is that okay? Is that going to sit well with your spirit? Or is that going to make you a nervous wreck? Because how you invest your money really is connected to that. Now, risk tolerance is different than risk capacity, because maybe you have a very high tolerance for risk. You can be super aggressive. You're like, baby, I'm going all in on Dogecoin. But maybe the amount of money you have doesn't really support you taking that big of a risk given your financial goals. That's the risk capacity. It's like, how big of a risk can you actually afford to take? Can you technically afford a potential loss? How much of a potential loss can you afford? That's risk capacity. Risk tolerance is how much of a risk are you okay with? Okay, so you definitely need to think about your risk tolerance, your risk capacity, and your time horizon when you are choosing what kind of investment to put your money into. So let's talk about, where should you put your money? I mentioned in that video I did about savings and why savings ain't really where it's at, that the easiest type of investment to get into is stocks and bonds, the stock market. That's the easiest. There are the least number of barriers to entry. So that's what we're going to talk about today, is if you want to get into the stock market, what should you buy? What should you not buy? I think for the vast majority of people, buying individual stocks is a bad idea. The thing is, as you are investing, you want to have diversity in your investments. You want to have a little bit of this, a little bit of that. That way, if one particular investment sort of goes down, you have a different one that is hopefully going up. If you are trying to do that and build a portfolio full of individual stocks, that's a really hard thing to do, because you're trying to pick stocks individually to give you diversity. The amount of thorough research that is necessary so that you can take a calculated risk and you aren't just buying something because everybody says it's hot. I don't know if y'all remember that whole GameStop AMC thing. There were people who had done the research and understood the risk they were taking and knew when to buy and when to sell. And then there were all the people who just jumped on the bandwagon who were clueless, and a lot of them lost their money. It is really hard, given that you got a job, you got a life, you got other things you need to do the kind of research necessary in order to pick the proper or the correct individual stocks to build a diversified portfolio. If you've watched any video on this channel, you know I'm all about how can we keep things simple and easy and low cost, which is why I don't think, I will tell you from my personal experience, I don't own individual stocks because that ain't how I want to spend my time. I want to spend my time traveling, sewing, hanging out with the dog. I don't want to spend it mired in stock research. If buying individual stocks is not the best way to go for most people, what do you buy? I think you've probably heard the term index fund before, and maybe you've heard the term ETF. ETF means exchange traded fund. For the most part, an ETF and a mutual fund are like a combo platter of stocks and bonds. So it's a way to get diversity, and those combo platters come in lots of different flavors, and you can pick a flavor that you really like. Like, let's say you are really into tech and energy. So you could pick a mutual fund or a ETF fund that is focused on that. So the term mutual fund, ETF, the difference between them is not enough for you to worry about right now. Remember, we want to keep things simple, easy, low cost. Of all the different flavors of mutual funds and ETFs out there, I think the easiest, the simplest, the low cost is to go with an index fund. You are familiar with some indexes, you just don't know that that's what they are. There are, like, you've heard of the S&P 500. That's an index. It's basically like a playlist of stocks. They are watching these 500 stocks. Well, you can buy a fund that says, we're going to try and match that. The thing about index funds is they tend to be lower cost because they are not actively managed the way a lot of mutual funds are. If a fund is actively managed, that means there is some person or some group of people doing the research, calling the shots about when to buy and sell various pieces of that combo platter. Well, those people don't work for free. They're not working out of the kindness of their heart. Their specialized knowledge has to be paid for, and that has to be paid for in either a higher cost of the fee or you're being charged specific fees for that. The beauty of an index fund is it's kind of like an index fund is not actively managed. A computer is making the decisions. It's kind of like using an algorithm. That's a lot cheaper to pay the computer versus to pay the manager for their experience. Now, I know what you're thinking, but isn't a person going to know better than the computer? Well, past performance has told us that no, sometimes managers get lucky, but on the whole, you can do just fine with index funds that are passively managed by like a computer or algorithm, whatever, versus actively managed funds. Stocks and bonds. The stock market, easiest investment to get into, okay? Requires the least amount of money, fewest barriers. What should you buy? Should you buy individual stocks? Not if you want to keep things easy, simple, and cheap. If that's what you want to do, you want to buy index funds. Those index funds can be mutual funds or they can be ETFs. How do you buy those? Because we said that a mutual fund and ETF is kind of like a combo with a mix of stocks, bonds, that sort of thing. There are two books that if you really want to dig into why this is a good idea, and you want the numbers and you want specific recommendations as to which index funds to buy for your specific situation, there are two books that I would recommend. The first is J.L. Collins' book, Simple Path to Wealth. The other is a book by Andrew Howman, The Millionaire Expat, How to Build Wealth Living Overseas. If you're looking at living abroad, Andrew Howman's book is like required read. We know what we should buy. How do we buy it? Because you can't just go to the store and do this. You need an account. Now, depending on your time horizon and the purpose of the money, that might impact which kind of account you need to purchase your index fund in. Now, there is a taxable brokerage account, and I've talked to y'all about that before. The thing about, some people get caught up in the word taxable because we're taught to fear taxes. Don't stress about that, because you only get taxed when you sell something and you make money. You've heard of capital gains tax. That's what that is. Capital gains tax are generally lower than income taxes. So don't get afraid of taxes, okay? But in a taxable brokerage account, this is money that's after tax you are putting in this account and using to buy stocks, bond funds, whatever. The beauty of this account is there are no strings attached to it. You can take that money out and use it for whatever you want, whenever you want. There are no strings attached. You have the most flexibility with a taxable brokerage account. I've mentioned to y'all in the past, I think you cannot go wrong with any of the big three: Vanguard, Fidelity, Charles Schwab. There are others out there, but remember, the focus on this channel is simple, easy, and affordable. Those three can do that for you. If you've ever heard of a Roth IRA, it's a Roth individual retirement account. Now, a Roth is a great tool for saving money for your retirement. But because of some of the rules associated with a Roth IRA, you can really use the money for a variety of things. So although it's often talked about as a retirement account, it actually can be used as a financial tool for other things as well. The general rule with a Roth is it has to be after-tax earned income. There are income limits. If you make lots of money, you probably make too much money to contribute to a Roth IRA. The range is like $140,000 for an individual person, or about $208,000 for a couple that's married filing jointly. If you make less than that, you can contribute up to $6,000 after tax into a Roth IRA. Why do you want to do that? How is the Roth IRA different than a regular taxable brokerage account? Well, here's like the best thing about a Roth IRA is you put that $6,000 in, you buy the appropriate investments, those investments grow fabulously, and you make all this money. All of that money you've made, you never have to pay taxes on it. That's awesome, right? And you're thinking, well, why would the government allow you to do that? Well, one, they want to encourage you to save for retirement. And two, you've paid tax on the money to begin with. And three, there's a $6,000 a year limit. Unless you're over 50, then you can contribute $7,000. So they don't let you go hog wild. They don't let super rich people do it. But for the average everyday person, a Roth IRA is a great way to go. I'm not going to get into it in this video. We can talk about it later if y'all want. But there are other things you can use that money for and not face any restrictions. Remember, with retirement specific accounts, there are more strings attached than with a brokerage account. Brokerage account, I can take my money out, use it for whatever I want, whenever I want. With the Roth IRA, I'm not supposed to access that money before I'm 59 and a half for retirement. However, this is another cool thing about the Roth. my initial investment, if I put in that $6,000 every year, even if that $6,000 grows to $100,000, the initial $6,000, I can take that out. I don't pay taxes. I don't pay penalties ever because I already paid taxes on that money. Now, if I try to take out the growth money before I'm 59 and a half, that's when Uncle Sam got some issues with me. Okay. So you've got taxable brokerage account, you've got a Roth IRA. Those are both after-tax money. There are pre-tax vehicles. And again, remember, these kinds of accounts, these are just, think of them as containers, think of them as baskets that hold your investments, whatever those investments are. We're not going to talk about it in this video, but you can, in some of these accounts, you can own things other than just stocks and bonds and, mutual funds, ETFs. You can own real estate, you can own other things, but we're not getting into that here. The pre-tax accounts, this is your 401k, your 403b. If you work for a government based employer, a 457 plan, this money comes out pre-tax. It grows in your various investments tax deferred. So that means these are intended for retirement. And when you reach retirement age and you start to sell off the assets in here, that money is taxed then. These are a good choice if you are a high income earner now and you would like to reduce the amount of money you have to pay in taxes. These will do that because the money comes off before taxes. And so it lowers your taxable income. I think the contribution limit here is $19,500 a year. And the idea is hopefully that when you retire sometime after 59 and a half, you are in a lower tax bracket. So when these are taxed as income, when you sell them later on in life, hopefully you are in a lower income tax bracket and you pay fewer taxes. These generally are work-sponsored plans. And as of late, there's actually been some, new flavors of these. So like the 401k, now there's a Roth 401k, which behaves like a Roth. I never worked for an employer that offered a 401k, so my retirement savings were primarily through my Roth IRA. I had a 403b briefly, and when I left that employer, I rolled it over into a regular IRA. But so if you don't have a job that provides you a 401k, that's not the end of the world. You can make other investments other places. And speaking of other IRAs, there is the traditional IRA. Let's say you work someplace that does not offer a 401k plan. Or even if you do, okay, this is another option. A Roth IRA, depending on who you work for, that money could come directly out of your paycheck, or it's money you put in later on. And then the income tax on that money, because you've technically already paid it, is tax deductible up to certain levels of income. So a traditional IRA is typically considered pre-tax, but it's considered tax deferred like a 401k plan, because when you deduct the income taxes from your tax return, so it's like you haven't paid taxes on that money, but then it grows tax deferred, and when you sell those assets later in life, that's when they'll tax you on them. Now, if you are considering moving out of the United States, whether to immigrate somewhere else, to be an expat for a few years, or as a digital nomad, you shouldn't stop investing. It's actually really imperative that if you spend a significant portion of the working years of your life outside the United States, it is imperative that you invest. Because if you're not working for a US-based company and paying into Social Security, you're not going to get Social Security. I mean, I'm not going to get Social Security, and I worked in the United States because the school district I worked for didn't pay into Social Security. But being outside the US, I'm not paying into Social Security. So if I were to spend 20 years outside the US working for international firms or doing whatever I'm doing, maybe you're not paying into Social Security. So you have your retirement is really resting on your own shoulders. So you really have to do your own investing. I did mention this before, but IRAs, whether it's a Roth IRA or a traditional IRA, if you live outside the US and you are taking the foreign earned income exclusion, and this is a link to the video I did on taxes where it talks all about that. But if you're taking the FEIE, basically you're exempting all of your foreign earned income from taxes. Well, to do a Roth IRA or a traditional IRA, you have to have earned income. So unless you earn more than 108 grand a year, you can't, because you won't have any taxable income that's earned, you won't be able to contribute to a Roth IRA or a regular IRA. So you've got to do some planning and some thinking if being outside the United States for a significant portion of the working part of your life, if that's part of your plan, you then have to step it up on the investment side. There are some other special considerations that if you're outside the United States, you need to think about. In that video I did on taxes, we talk about FATCA. Basically, these are a lot of financial paperwork reporting requirements that foreign banks have for US passport holders and green card holders. Long story short, it makes it harder for you to open financial accounts overseas because people don't like dealing with the hassle of the IRS. So one thing you have to consider is, or one thing I tell everybody to do before you leave the US, open all of the different kinds of financial accounts you can. Because of FATCA, we have found expats getting their accounts closed, or they're having a really hard time opening new accounts. People have done better already having existing accounts. Okay, so before you leave, open that taxable brokerage account. Open a rollover IRA in case you've got an old 401k somewhere. You know, do all that stuff before you leave. So that's one. I know a lot of people move outside the US and they start thinking, well, I'm living in this new country, maybe I should invest in different financial vehicles here. That is going to be more pain in the butt than you want to deal with. So let's say you're living in Germany and you want to buy a German index fund or some kind of investment fund in Germany. They'll let you do it. But what people fail to tell you is that the IRS considers that to be a passive foreign investment company. Basically, if you invest in funds that are not based in the US, they're foreign, the IRS taxes them punitively. And there's a shit ton of paperwork that goes along with it. And a lot of people don't know this. They are like, well, I've been working in this country for 5 years. They invest in that country. Then they come back to the US, or when they file their taxes, they find out like, whoa, the IRS does not really like this. You can technically do it. It is not an illegal thing to do, but from a tax standpoint, from a paperwork standpoint, it's going to be a pain in the butt. And remember, we're about keeping things simple, easy, and affordable. So investing in foreign countries, I'm not talking about like real estate investment. I'm not talking about that. I'm talking about like financial investment, stocks, bonds, funds, that kind of thing. Do your research before you do that, because you don't want an ugly surprise. Something else that doesn't get talked about a lot, foreign jurisdictions cannot regulate investment funds outside of them. So that's part of this thing with the IRS. But the opposite is true too. So you're living in Germany, but you want to buy mutual funds in the US. Well, There is no German authority that can regulate that those funds you're buying in the US, those mutual funds, aren't shiesty. Most places will prohibit you from buying mutual funds if you're not in the country where those mutual funds are registered. This even applies to US citizens, okay? So I was living in China. I could not go to a brokerage firm in China to buy an American mutual fund. Like we hear people talk about VTSAX from Vanguard. I could not buy that. Nobody would sell that to me because I was outside the US. They don't have any kind of jurisdiction over this fund based in the US, even though I'm an American citizen, okay? Now, I know that the reality is if somebody already has a US brokerage account and they just go online and they use their VPN, it appears that they're in the US making that purchase. I know that. I'm just telling y'all what technically is the situation. Whether that's going to get enforced or not where you are, who knows? The way around that is to simply buy ETFs instead of mutual funds. This specifically applies to mutual funds. Does not apply to ETFs. I was buying ETFs even when I lived in the United States, so when I left, there was no change for me. Did I answer your questions? Do you have new questions? If so, let me know in the comments. I mentioned to y'all before, next month, which if you're watching this in the future is September 2021, will be the first launch of my Financial Confidence Bootcamp 4-week program that is meant to help you build your base of financial knowledge, empower you with enough confidence to take control of your finances so that you can move forward in your plans to build wealth, make money, whatever. I'll put a link up here. It's linked in the description as well. bit.ly money-bootcamp. What should you watch next? Now that you've watched this video, if you have not watched the video that I did about do I have to pay taxes if I live outside the US, you should watch that. You should also watch my video I did about saving and investing called Saving is a Losing Game. Both of those are linked in the description. Thank you for watching. If you haven't subscribed, please do so. If you know somebody who would find this information useful, please share this video with them. Till next time.